In this lesson, we will learn about Introduction to Leveraged Buyouts and key features. Definition and basic concept. A leveraged buyout, LBO, is an acquisition transaction in which one company acquires another by using a significant amount of borrowed money. The debt used in the deal is usually secured by the target company's assets, along with the acquiring company's assets. Also, the target company's income, usually EBITDA, is the primary source of future debt repayment. This allows the acquiring company to make large purchases without having to commit a lot of its own capital. Purpose and benefits. The primary objective of an LBO is to enhance the return on equity, ROE, invested by leveraging the investment. That can be achieved through operational improvements, strategic repositioning, and financial restructuring of the acquired company. LBOs enable companies to make large acquisitions with relatively small equity investments. Additionally, the interest payments on the debt used in LBOs are tax-deductible, providing the acquiring company with a tax advantage. Historical context and evolution. LBOs gained popularity in the 1980s, with the RJR Nabisco deal by KKR becoming a famous example. However, the 2008 financial crisis and tightening credit markets led to a decline in LBO activity. In recent years, LBOs have seen a resurgence due to improved economic conditions and easier access to credit. A notable recent example is Blackstone's 2021 acquisition of Medline, valued at $34 billion, one of the largest LBOs in recent history. This deal involved substantial debt, with future Medline cash flows expected to service the debt incurred during the buyout. Sources of equity financing. Equity contributions typically range from 20% to 30% of the purchase price, but this can vary depending on the deal's specifics. Equity financing comes from various sources. 1. Private equity firms. Role: provide a significant portion of the equity required and are often the primary initiators of LBO transactions. Purpose: leverage their expertise to improve the target company's value and generate high returns on their investment. 2. Strategic investors, corporations. Role: large corporations participate in LBOs, especially if the target company aligns with their strategic goals. Purpose: leverage their financial strength and industry expertise to gain a competitive advantage and create synergies with their existing businesses. 3. Management rollovers. Role: current management rolls over their existing equity into the new capital structure. Purpose: align their interests with the new owners, demonstrating confidence in the company's future prospects and incentivizing performance improvement.